Guys, all the big moves that we expected to take place over the course of the next week or 2 weeks has actually happened literally within a couple of days. So if you haven't reviewed the last video when we were bullish on the market, please do so you can understand the reasons why. But in this video, we're explaining why we're turning into a short-term bear. And the main observations that we're seeing, the risk reward is simply currently on the bear side at this point because we're observing that institutions are coming in and selling. Today, February 13th, we actually, based on our markets move formula, we had a move 6. Now, you might have not watched the video that is called Move 666, which was preceding the huge drop that was posted on this channel. So if you're trying to understand some of these market moves and how they work, definitely we'll explain everything in great detail in the 13 Markets Move Formula course. But just for simplicity and quick explanation of what this is here, I want you to pay attention to what S&P 500 was doing today. So it actually looked very bullish as it opened, and then it had a minor sell-off intraday, which was not a big deal because a lot of times it'll lead to move 6 when the markets rebound because the market is still positive here, right, in relation to where it was the previous day. Notice the volume. The volume on the first drop was quite insignificant, but look at this. You see these two red lines. They're literally parallel to each other. I have these purple arrows pointing to them. So they're parallel to each other. And the second time, we're getting a huge spike in the volume. So all of our alert subscribers have literally 15 minutes, 10 minutes before the close of the session today, February 13th, they've gotten a warning to get predominantly out of all of their calls, with the exception of a couple of biopharmaceutical stocks that we've been placing some trades on that we're waiting for some news to come out. But other than that, we suggested predominantly to close majority of these call positions because in a lot of times situations like move 6, the next day follow for either going to get an 11, which is another top in move, or a move 3 where the markets actually gap down and they drop. It's important to understand that this is actually signals of a market top, even though we're not at the top, but the market has been going substantially higher for close to a month and a half. One of the conditions we described in the last video was as long as the market holds above 2,700 and the VIX holds under 16, it makes sense to remain bullish. However, when you get striking with a move 6, like here, it's time to be cautious. It does not mean that certain stocks are not going to be able to go higher. Certain stocks will. But overall, this is a dangerous minefield to be walking on if at this point you are wanting to remain a bull. In the last video, I said, well, our target for S&P 500 was going to be 2770, 2780. I feel good with completely shifting into a bear right now, even though we didn't hit the precise levels of 2770, 2780. We did hit this high of 2762. And after we did that, look, 1, 2, 3, 4, 5 tops intraday. After that, quick sell-off. Get back to the 2760, and we can't hold that level again. So those are not good signs. That tells us that finally the market is showing signs of exhaustion, to where it seemed like no bad news could just sink it. Finally, we're at the point where we're seeing, when you see this red lines parallel to each other, when you see the spike in volume confirmed by the huge sell-off and the accumulation, literally within minutes going into the close, that spells trouble. That spells the fact that we're not necessarily crashing, but that we could have quite an easy drop the next day or the course of the next few days. So move 6 typically leads again to a move 11 or 3. If you'd like to learn how this stuff works, or if you'd like to get a better understanding of how we were able to predict the big major drop in December before it actually took place, it was based on our combination of market moves and probabilities that we follow in the 13 Markets Move formula. Now, here's the next question. What is one thing in the next 5 charts I'm going to show you that you see in common? And a couple of hints here. Do you see some selling? Do you see some black candles? Maybe there's some other things that you will be able to see. So the first chart is S&P 500. Again, February 13th. This is how the markets closed today. Basically, we're looking at this black candle right here in December And the reason I'm bringing this black candle, because look at this one today, February 13th. This is almost identical, guys. This is almost identical to this candle. And surprisingly, both happened just above this orange line. In the last video, I've said that, okay, oftentimes, because a lot of people were saying, okay, no, we're dropping, we're going to drop lower, lower. And so we did go consecutively now 4 days higher since that. And a lot of people are probably thinking, okay, well, now that we're above the orange line, this is the time to get in. Well, if we're to draw a line here, we're actually, this is going to be the last lower high in this sequence of lower highs. So this would be the first one, the second one, another one here, and this would be the next lower high. From here, we can easily retrace back to 2650. So not looking for a huge drop, but maybe a pullback of about 100 points. I don't think we're going to breach the blue line, and I don't think we're going to actually touch the blue line. So this 2650 probably would be a good level to consider if you want to turn into a short-term bear. But again, black candle, you know what happens after the black candle here. If you're not familiar with the black candles, guys, check out our charts and divergences course. There's a part of the course that speaks specifically about all the details, how to read these black candles, but just understand that they represent short-term selling by institutions. So when you see this, get ready. When this coincides, especially with the move 6, there's a very high probability that the market will correct. Next chart, Nasdaq. Do you see how similar this thing is here as well? Black candle, drop, black candle, most likely a drop coming. Next chart, woo, Amazon. Goodness, look at all these black candles all over this place. So here's one. Here's another one. The reason I'm circling these because they're important. They're important because they happen at certain levels, right? So this one happens just as we're breaking above this orange line, and then the next day we get a drop. This one is on the orange line and we get a drop, and this one is just above the blue line, and I'm pretty sure it's going to be a drop. Okay, next one, BABA. Whoa, what we got going on here? Check this out. The black candle. Okay, now look at this. We got 3 back to back, and it's not just the black candle sometimes, but the formation of the candle, right? We got these 3 tails of the candle sticking out, like 3 little failed rocket launches. Boom, they're up there. They're coming back to Earth, and it's just sitting on this line, so chances are we're going to get a move lower from there as well. Google, same thing. Black candle, black candle. Guys, the reason I'm showing you this and I'm so focused on these black candles, because that tells me institutions are selling at these levels. And if the institutions are selling at these levels, there's 2 things that are going to happen. It's going to be very difficult for us to catch a break higher, substantial break higher above this. One of the things I mentioned in the last video was it was sort of a cup with a handle that was forming. I mentioned it could be a failed breakout out of this cup with a handle, and that's exactly what we're getting. It looks like on Google. It tried to go today to 1140, and then it finished lower on the day at 1128. Very critical level, right? It needs to stay above this for it to go to 1,200, 1,300 bucks. As we mentioned, it had a great probability of doing, but it's no longer the case. It's a failed breakout, guys, so be very careful. When institutions are selling, some of this selling may not happen over the course of 1 day, so we could maybe reinitiate being a bull at some point at these lower levels here, but from here on, this is a very dangerous zone to be a bull, because the risk reward and everything we're observing on these charts is telling us that there is a high probability of a reversal lower at this point. Now here's the VIX, right? The VIX today is still at 15. It's still under 16, but look at these formation of this candle right here. It's actually a bullish reversal candle. So the exact main reason in the last video we were pointing that the market was going to go higher because we had two bearish reversal candles here. Now we got a bullish reversal candle, and basically telling us that if VIX does breach this level of 16, at this point we have a high probability of moving to 20. At the same time, I'm going to give you a trade that I am considering, and we were actually sending the alerts to buy the Amazon puts before the close, but just after market, looking at the charts now. Again, this is a chart of February 13th, BKNG, today hits a level of 1919, I think that would be one of the positions I would be shorting tomorrow. Because clear divergences right here. There's a ton of things, right? Expedia announces killer results, and what happens? It sells off. It should have gone higher. So on the Expedia results, BKNG typically rallies significantly higher. It did on very low volume, and then it gave up all the gains. So currently against this level of 200 moving average, this orange line right here, I think this is a good entry to short this thing. As you can see, as the stock moves higher, the volume, the buy volume, continuously goes lower. And if we look at the accumulation, maybe nobody's actually buying. Maybe somebody's just setting this whole thing up so they can sell a ton of shares. And I think that's exactly what's going. So short-term target 1820 on this one. Not to mention just another confirmation, right? So Facebook rallies higher significantly. What happens to the accumulation? Nobody's really buying it. So that's a nice little setup. It doesn't mean that Facebook is going to drop like crazy, but it also tells us that it's not going to move substantially higher in the near term. So the key takeaways in this short video, guys, are these. We're seeing institutional selling in current levels. Selling coming in all types of different stocks. It no longer makes sense to remain a bull short term. We're just talking from the perspective of trading weekly options, bi-weekly options. We think that the pullback is very likely. S&P is very likely to hit 2650, and if that happens, BKNG should trade at the level of about 1820. It's at 1920. I mean, we're talking about a $100 drop here, possible within the next week or so. So, guys, thanks for watching the video. I hope this was helpful, and I'll catch you on the next one. Happy trading to everyone.